Hey crypto friends, my name is Garrett and welcome to Altcoin Radar. Today guys, we're going to learn all about liquidation in the crypto market and how you can avoid it as much as possible. And guys, I'm not going to lie, for this video I am reading from a script that I've written because it's a little bit of a longer video. So if I sound like an idiot who's never read a book before, that's why. All right, guys, so it's pretty darn safe to say that with the crypto market's high volatility on a regular occurrence, it definitely means liquidations are a common occurrence, and they definitely are, you guys. Liquidation in the cryptocurrency market freaking sucks, okay? But it does happen more often than you think. So guys, Bitcoin and other cryptocurrencies are known for being very high risk investments that are prone to extreme price swings. But guys, these price swings also present an opportunity for investors to generate significant profits, particularly when compared to traditional assets, such as like stocks and commodities, for instance. In fact, you guys, in 2020, Bitcoin ended the year 160% 160%, versus the S&P 500, which ended the year at 14% in profits, and gold up only 22%. So, I mean, when you see those types of numbers, you start to think to yourself, I mean, which one should I really be in here? Anyway, you guys, adding to this volatility is the potential to increase the size of crypto trading positions through the use of derivatives products, such as margin trading, perpetual swaps, and futures trading. See, guys, derivatives are contracts based on the price of an underlying asset, and they allow people to bet on the asset's future price. And you guys, crypto derivatives first appeared in 2011, and they have gathered huge momentum. I'm talking huge momentum, you guys, in the most recent years, especially among, people, retail investors like myself, who are looking to make the most profits that they possibly can, because you can make a crap ton of money from from derivatives, you guys, from trading futures and stuff like that, simply because you can trade with leverage. And guys, with margin trading, traders can increase their earning potential by using borrowed funds from a cryptocurrency exchange. For instance, Binance, KuCoin, and MEXC, which is, by the way, the exchange that I personally use. If you want to go ahead and try it out, you can. There's a link to it in the description below this video. Other than that, you guys, Binance, KuCoin, and MEXC, these are all exchanges. These are all some of the leading examples of, centralized crypto exchanges that allow customers to trade with margin. However, you guys, there's something very important to note here. While borrowing funds to increase your trade positions can amplify your potential gains, you can also lose your invested capital just as easily, you guys. In fact, you can honestly lose all of your money in literally less than 10 seconds. I mean, if you don't know what you're doing. Trust me, you guys. It happened to me in my early days of trading the crypto. It happened to me in my early days of trading, the crypto futures market. When I didn't know what I was doing, like I've said, I've mentioned this in some other previous videos of mine as well that have to do with crypto futures. In the very beginning, I made a crap ton of mistakes. I didn't know what the heck I was doing, you guys. I lost a ton of money, but you live and you learn from your own mistakes, and that's exactly what happened. Now I don't have those issues. Anyway, you guys, in addition, margin trading involves increasing the overall amount of money you have to trade with by borrowing third-party funds. Think of this as, think of it like this, okay? You're pretty much borrowing money from you're pretty much borrowing money from some random bro on the street to buy Bitcoin or another cryptocurrency, okay? That's literally pretty much how it is. But in this situation, pretty much what you're doing here is you're borrowing from the crypto exchange, which allows investors to increase the overall size of their, trading positions, which, is also known as leverage, okay? Now, naturally, you guys, a random dude on the street would not lend this kind of money to you for free, okay? Similarly, in margin trading, the exchange will require you to put up, the exchange is going to require you to put up an amount of crypto or fiat, as a collateral, which is normal, and, it's known as an initial margin, okay? And in order to open a trading position, and this initial margin is this initial margin that you're paying is pretty much like insurance. It's pretty much like an insurance fund for the exchange in case in case the trade ends up going south, pretty much. Also, you guys, it's also worth mentioning here that the amount of money you can borrow from an exchange relative to your initial margin is determined by the overall leverage. Okay. For example, you guys, if you use 5x leverage or is that the example I use? Yeah. If you use 5x leverage on an initial margin of $100, you'll be pretty much taking out a $400 loan to increase your overall trading position from $100 to $500. Okay. So can you see where that you can kind of visualize and see where I'm coming from on that, okay? Again, if you're using 5x leverage on an initial margin of $100, you're pretty much going to be borrowing $400 to increase that position from $100 to $500, okay? Now, guys, each trade has the potential to make or lose money depending on the overall size of leverage, okay? For instance, using the 5x leverage, like I just talked about a couple seconds ago, if the price of an asset rises by 10%, you're pretty much going to make a profit of around $50 on that, okay? You're going to make a profit of about $50 on your $500 trading position, which represents a 50% profit relative to your initial $100 margin, okay? Now, guys, you could then repay the $400 loan that you took out and keep $150 for yourself, which includes the $50 profit that you made and your $100 initial margin. So now you've got $150, okay? However, you guys, if the value of the cryptocurrency that you're trading, drops by 10% instead of rises, you could have lost $50 from your initial margin, which would be a 50% loss, which would be pretty damn huge, you guys. This is where I was talking about in previous videos about how dangerous leveraged trading is, or crypto futures trading is, if you don't know what you're doing, okay? Overall here, though, you guys, in general, please remember, please remember, you guys, that leverage trading is how much your initial margin can gain or lose, and you want to make sure that you keep your potential losses to manageable levels, okay? It's very, very important here. Now, guys, in the context of cryptocurrency markets, liquidation refers to, it pretty much refers to when, an exchange forcefully closes a trader's leveraged position due to a partial or total loss of the trader's initial margin. This typically happens, you guys, when a trader is unable to meet the margin requirements for a leveraged position, and liquidation occurs in both margin and futures trading, okay? Overall here, though, you guys, trading with a leveraged position is very, very high. It's a very high risk trading strategy, and it is possible to lose your entire collateral if the market makes a large enough move against your leveraged position. This has happened to me many times in the past. You cannot predict it. You just can't, you guys. We've all seen it many times where coins, they'll literally take like a 20% spike upwards in a matter of seconds, and then literally a 5 seconds later, it'll make a drop that's double that same size. There are so many liquidations that are happening within that small little time frame. It's not even funny. So this is why it's very important, you guys. So guys, when using leverage, there are definitely a handful of options, though, available to you to be able to help you to mitigate the chances of being liquidated, okay? And one of these options is known as a stop loss, okay? Now, we've all probably heard of a stop loss. If you're into trading or you've ever traded before, you've probably heard of a stop loss before. It's pretty much an advanced order that an investor places on a cryptocurrency exchange or any kind of exchange that basically instructs the exchange to sell the asset when it reaches a particular price point, okay? So guys, when you're setting up a stop loss, you'll need to input a stop price, which is, the price where the stop loss order will execute. You'll set a sell price, which is the price at which you plan to sell the particular crypto asset, and then the overall size, which is the, how much of the particular asset that you plan to sell, okay? Now, guys, The primary purpose here of a stop loss is to limit potential losses, okay, you guys? To put things into perspective, I'm going to go over two different scenarios here real quick so that it's easier for you to understand, okay? So guys, the very first scenario I want to talk about here is picture a trader that has $5,000 in his account, but he or she decides to use an initial margin of $100 and leverage of 10x to create a position of $1,000, okay? So think about this, you guys. He's not trading his entire $500 or $5,000, okay? He's literally only trading a small portion of it. He's trading only $100 of it, and he's using 10x leverage, okay, to create a position of $1,000. He ends up placing a stop loss at 2.5% from his entry position. So in this instance, you guys, the trader could potentially lose $25 in this trade, which is a mere 0.5% of his entire account size. So overall here, you guys, this is what I'm talking about mitigating your losses. You really have to go through and really, really set these numbers right if you want to be able to, have accurate results, and you want to be able to be profitable and, be able to mitigate your losses and manage your risk properly. So guys, in this scenario, if the trader does not use a stop loss, his overall position will be liquidated if there is a 10% drop in the in the price of the asset. Now guys, in another scenario I want to talk about real quick is scenario 2, okay? Now picture another trader that has $5,000 in their trading account as well, but instead they're using an initial margin of $2,500 and a 3x leverage, okay, to create a position of $7,500. So guys, by placing a stop loss at 2.5% away from his entry position, the trader could lose $187.50 in this trade, which would be roughly a 3.75% loss from their overall account. So the lesson here to be learned, you guys, is that while trading or while using higher leverage is typically considered very, very risky, this factor becomes very, very important if your position size is way too large, okay? And this is something that I see a lot of people do, okay? Here's the thing. Oftentimes I see a lot of people go into the futures market and they go in there with like $1,000 and they think they need to be trading with that entire $1,000. That's not how it works, you guys. You should never be risking that kind of money, you guys. So realistically, you guys, me personally, when I enter the futures market, I'm usually going into the futures market with about 10 grand at a time. I'm never entering I'm only entering positions with literally 2 to 3% of that $10,000, okay? That way I'm able to enter into multiple positions and manage my risk a lot easier because I'm not using my entire portfolio, you guys. So guys, when it comes to margin trading overall here, you guys, risk management is arguably the most important lesson here, okay? Your primary goal should be to keep losses at a minimum level even before thinking about your profits, you guys. No trading model is infallible, okay? Remember that, all right? Therefore, you guys, you must deploy mechanisms to help you survive when the market doesn't go as expected, okay? So with that said, you guys, placing stop losses correctly is vitally important. And while there is no golden rule for setting a stop loss, a spread of roughly, 2% to maybe 5% of your trade size is often recommended, you guys. Alternatively, some traders prefer to set stop losses just below the most recent swing low, okay? So keep that in mind as well, all right? Secondly, you guys, you should be managing your trading size and the associated risk as well. Now, the higher your leverage, the higher your chances of being liquidated, okay? So remember that as well. So if you're trading and you choose to pick, 5x leverage, over, instead of choosing 25x leverage, somebody who chooses 25x leverage is going to have a much higher chance of getting liquidated than the guy that's only using 5x leverage, okay? Now, guys, using excessive leverage is definitely exposing your capital to unnecessary risk that you definitely do not need, okay? In addition, you guys, some exchanges actually manage liquidations very aggressively, okay? For instance, exchanges like MEXC, for instance, they only allow traders to hold Bitcoin as, an initial margin, for instance. This means that, if Bitcoin's price falls, so too does the amount of funds held in collateral, resulting in faster liquidations as well, you guys. Oh, in addition, you guys, lastly, due to the risk associated with leverage trading, some exchanges definitely have moved to lower limit traders, lower limits that traders can access. Okay. Both Binance and FTX, for instance, are among the leading centralized crypto exchanges that they've literally slashed the limits from like 100x to 20x, and they've done this at times before, which isn't necessarily a bad thing since it helps traders to mitigate their overall losses and reduce the likelihood of potentially getting liquidated. And that's the overall goal here, you guys. If you don't want to get liquidated, you just gotta you have to know how to manage your overall risk here, you guys. That's the most important part, all right? And again, you guys, I love to help people. So if you got any questions about this stuff whatsoever, hey, reach out to me on Twitter. This is why I created my channel, was to be able to help people out, help beginners out who want to get into this stuff and they just don't know how, or they get confused or something like that. Because I was there once too, you guys, and I just love to help people in general, okay? Overall here though, you guys, that's going to pretty much do it for this video. So I will go ahead and wrap this one up. But again, guys, before you guys leave, go ahead and make sure to subscribe to the channel so that you never miss a new crypto and altcoin video from me on a regular basis. And hey guys, with that said, thanks again for watching, and I hope to see you guys in the comment section of my future videos.